Hello. In this next series of videos, I'll be going through a comprehensive problem where we go through an unadjusted trial balance all the way to post-closing trial balance and preparing the financial statements in between. So I'm not sure if this will be a series of 3 videos or 4 videos, just because I'm unsure of how long it will take. But I will clearly label it if it's video 1 of 3 or video 1 of 4, etc. But we're going to go through this problem, and let me just read it. Pastina Company sells various types of pasta to grocery chains as private label brands. The company reporting year-end is December 31, and the unadjusted trial balance is provided. We're giving the set of 6 steps of directions. Starting with number 1 is enter the unadjusted balances from the trial balance into T accounts. And then we're going to prepare the year-end adjusting journal entries and post those into the T accounts, which will allow us to prepare an adjusted trial balance. From there, we'll be able to prepare 3 financial statements: the income statement, balance sheet, and statement of stockholders' equity. And then we're going to close those entries, post the closing entries, and post it to T accounts, and then we can prepare a post-closing trial balance. Okay, so we're given in the problem right here in rows 7 to 35 is our unadjusted trial balance. So these are all the balances from entries that the company has accumulated throughout the year, but has not yet posted the year-end adjusting journal entries. We're going to go through just a few of these accounts, and I'll show you how to post them into the T accounts, and then the rest of the T accounts will be filled in, but it's all the same process. It's just monotonous just to go through every single one. But our first account is cash, and we have $30,000. And please be careful whether it's a debit or a credit. Okay, so this is cash is in the debit column, which is normal, the normal side for an asset, and it's $30,000. So I'm going to scroll down to the bottom of this sheet, and here's where I have my T accounts. For the balance sheet, I put on the left side, and the income statement is going to be on the right side. And T account, it looks like a T. There's a line across and a line going down. And if you recall or don't recall, debits on the left and credits on the right. I've posted a funny little video that will get stuck in your head if you can't remember that. Debits on the left, credits on the right. So the cash is a debit balance of $30,000, and what I'm going to do here is I'm just going to put $30,000, and I'm going to label it as my unadjusted 12/31/2027 balance. Then I'm going to go back up to my unadjusted trial balance and look at my next account as accounts receivable for $40,000. So I'm going to come down. It's a balance sheet account. Here's my accounts receivable T account. And again, I'm going to put a debit for $40,000 and label it unadjusted 12/31/2027. Whenever you post a T account, it is really important to label what every item is, because it's easy to get confused, especially when you have multiple entries going to the same T account. Now I'm going to just move on to the income statement item accounts. Here I have sales revenue, and this is in the credit column. So debits on left, credits on the right. So I'm going to find my sales revenue T account and put this $146,000 all the way on the right. So here on the right side of my spreadsheet, I have my income statement T accounts. Here's my sales revenue, and then I'm going to put that $146,000 on the right side. And then the last balance I'm going to show you how to put onto the T account is a cost of goods sold. That is an expense account, and the expenses and normal balances are debits, but this is a debit. So we're going to put $70,000 on the left side, debits on the left. Debits on the left, credits on the right. So here's my cost of goods sold, $70,000. And if you look through here, the rest of the balance sheet, I have populated all the beginning unadjusted balances for that we were given in the problem for all the balance sheet accounts and same with all the income statement accounts right here. So salaries expense, we started out with $18,900. Okay, next item after we post onto the T account, so we've done step 1, is step 2, and that asks us to prepare the year-end adjusting journal entries and post them to the T accounts. So first we have to figure out what the journal entries are and then post each of those entries into the same set of T accounts. So item number 1 that we're told is depreciation on the office equipment for the year is $10,000. So we need to record our depreciation for the year for $10,000. Our entry is going to be debit depreciation expense for $10,000, and the credit is going to go to accumulated depreciation. That is a typical entry for posting depreciation expense. And then we have to post these to the T account. So you have to do for each side of this entry, each account that the entry hits, you have to post each one of those into the T account. So I have depreciation expense, debit $10,000. I know that depreciation expense is an income statement account because it's an expense. I'm going to find my depreciation expense right here, which I'm circling with my mouse. From my unadjusted trial balance, we did not have any depreciation expense, which makes sense because we're only booking it at the year end. And we have, here's my journal entry number 1 that I labeled, and it's a debit for $10,000. It goes on the debit side, on the left side. And then the other part of this entry is credit accumulated depreciation, which is a balance sheet contra asset account. So because it reduces the asset, whether it's equipment or building, whatever it might be, it reduces that account. It's a contra asset account. We'll learn about that in later chapters. But here's my accumulated depreciation T account. My unadjusted trial balance already had a balance of $30,000, and I'm going to credit it for $10,000 for this first adjusting entry, year-end adjusting entry. Okay, let's go through item number 2, the second adjusting entries. Employees are paid twice a month on the 22nd for salaries earned from the 1st to the 15th, and on the 7th of the following month for salaries earned from the 16th through the end of the month. Salaries earned from December 16th through the December 31 were $1,500. So there's a lot in here, and I want to just kind of go piece by piece. So it tells us the employees are paid twice a month. And on the 22nd, meaning on December 22nd, when the employees got paid, it was for the salaries that were earned on the 1st through the 15th. So this was paid on December 22nd. So if they had an accrual on the books, they would have debit their salaries payable and credited cash because they paid it out. So we're really not focused on what happened on the 22nd for purposes of the year-end adjusting journal entries. And it's really on the 7th of the following month, which means on January 7th of 2028, in this example, the employees are going to get paid for the salaries that they earned between December 16th and December 31 of the previous year or the previous month. So at 12/31, we need to accrue for those salaries because they have actually been earned and we owe them to the employees. So we're going to record a debit of salaries expense for the $1,500 and credit salaries payable. And then we're going to have to post those into our T accounts. So that's like, we have a debit to salaries expense for $1,500. I'm going to go down to my income statement, and right here on my salaries expense T account, you'll see this journal entry number 2 for $1,500. And then I'm going to move over, to the left to my balance sheet account, which is where my salaries payable will be. And it's right here is my T account for my salaries payable. And I'm going to credit salaries payable for my $1,500 and label it journal entry number 2. So I know what every single entry is for. In this particular account, we did not have any balances come through on the unadjusted trial balance. And that's because, that makes sense, because on the 22nd, we paid out our employees. So we would have, any credit balance that we had on our salaries payable, we would have debited it out because we paid it. Again, I cannot stress the importance of understanding how to do journal entries and understanding the debits and credits and knowing the normal balances for each of your accounts, whether it's an asset account, liability account, or equity account. And if you need to review that in your financial accounting book, please go ahead. Please look at YouTube. Please ask AI. But you need to know this inside and out for the rest of this class. And if you have any future accounting jobs, if that's what you're pursuing, you'll have to know that like the back of your hand. Okay, let's go to item number 3. On October 1st, 2027, Christina borrowed $50,000 from a local bank and signed a note. Let's just stop right there. I want to just go through the journal entry that would have been recorded on October 1st. I know that's not part of this problem, but if Christina borrowed $50,000, they would have debited cash for $50,000 because it increased their assets, and they would have credited a note payable because now they owe that money to the bank for $50,000. So but the note, the second sentence in this item says the note requires interest to be paid annually on September 30th at 12%, and the principal is due in 10 years. So the fact that the principal balance, which is the original $50,000, is due in 10 years, for purposes of recording our interest, is irrelevant. So that's just additional information that we're given, but we don't really need to use it. Now, the interest has to be paid on September 30th. Okay, remember we're doing this as of December 31. So we've had this note from October, and when we think about through December, we owe interest to the bank on that note. Even though we're not paying it out till September 30th, we're still owed. We still have to accrue that liability because we do owe the bank for that interest. So we need to accrue interest for the month of October, November, December. So for 3 months. So what I'm going to do is I'm going to take my interest expense. I'm going to take my principal balance that of the note, which is $50,000, times the annual interest rate, which we're given is 12%. But as of 12/31, which when I say 12/31, I mean December 31, I only owe 3 of the 12 months worth. So I'm going to multiply that by 3/12, and that gives me $1,500. So I'm going to debit interest expense for $1,500 and credit interest payable for $1,500 because that's what I owe. I'm going to go through and I'm going to post those into my T accounts. My interest expense is a debit $1,500. That's an income statement account. I'm going to find my interest expense T account, which is right here. And you'll see right here, I debited $1,500 for my journal entry number 3. And then my interest payable is a balance sheet account. And I'm going to find that T account right here. And I'm going to credit that amount for $1,500 right here. You can see in the T account. Okay. Going forward, I'm not going to go through the posting of the T accounts for any more of these adjusting journal entries because I think it's relatively easy and self-explanatory. So we're just going to move through these next 5 entries, or 6 entries, I should say. Okay. So number 4, on March 1st, 2027, the company lent a supplier $20,000 and a note was signed requiring principal and interest at 8% to be paid on February 28th, 2028. So on March 1, we lent a supplier $20,000. So on March 1st, we would have recorded debit notes receivable for $20,000, credit cash for $20,000, and they have to pay us 8% interest on February 28th of the following year. So from March 1st of 2027 to December 31, 2027, the supplier owes us interest for that period of time. And so we need to record a receivable for that amount. And the way we're going to do that is we're going to debit interest receivable. We're going to take the the principal value of that note, which is $20,000, multiplied by our annual interest rate of 8%, times the number of months that we're owed interest for, which is 10 out of the 12 months, because we lent the supplier on March 1, so there's 10 months remaining in the year. So that number ends up being $1,333. I'm going to debit interest receivable and credit interest revenue for that amount. Okay, so interest revenue is an income statement account. Be careful with your debits and the credits when you're posting it to your T accounts. Number 5, on April 1, 2027, the company paid an insurance company $6,000 for 1 year fire insurance policy. The entire $6,000 was debited to prepaid insurance at the time of the payment. So on April 1, we paid a policy, a fire insurance policy in advance. We would have debited prepaid insurance, which is a balance sheet account, and credited cash at $6,000. It was a 1 year policy. And so now at December 31st, we have used up 9 months out of that policy, right? From April 1 to December 31 is 9 months. So we need to reverse out, we have to reduce our prepaid insurance by that, whatever we have already incurred or used. And we need to debit our insurance expense. So we're going to debit insurance expense for $6,000 times the number of months where we've actually used up that insurance, which is 9 out of 12. So that number will be $4,500. And we're going to reduce our prepaid insurance account by that number as well. So $4,500. I want to go into this prepaid insurance T account specifically just so you can see what happens to it. It's a balance sheet account. It's going to be right here. And look, so we have an unadjusted balance of $6,000, and we're actually missing the journal entry, right? Because what number journal entry is this? The prepaid, it was journal entry number 5 for $4,500. So we should have a credit of $4,500 for journal entry number 5. And that's what I would label it as. Let me just do, because I'm a little bit anal, I'm going to do the same font. So now you see my unadjusted balance, my adjusted 12/31/27 balance. We have $1,500 remaining at the end of the year of worth of insurance that we've paid up for. Okay, let's go to item number 6. It says $800 of supplies remained on hand on December 31, 2027. So when we look at our supplies account on our unadjusted trial balance, we have $1,500. And what happens is that at the end, after year end, someone physically or people physically have to go into supplies and count out supplies. How much supplies do we have? How much paper? How many paper clips? How many staplers? You'll be surprised that this actually does get done in companies, so that we get the right supplies account amount on the supplies account. And so after doing that, they realized that only $800 worth of supplies was on hand, and our balance is $1,500 on our unadjusted trial balance. So we need to reduce our unadjusted trial balance by $700 so that our ending balance in the supplies account will be $800. So we're going to, which means that we have used $700 worth of supplies throughout the year. So we're going to debit supplies expense $700, and we're going to credit supplies. We're going to reduce this balance sheet account by $700. So then when we go to our supplies T account, we should see a balance of $800, which is what item number 6 is telling us. And again, this journal entry is missing. So I'm going to put the $700 right here. And this is journal entry number 6. And there we go. Okay. So, and then we have an adjusted balance at the end of the year of $800, which is what we were told it should be. Okay. Item number 7 is the company received $2,000 from a customer in December for 1,500 pounds of spaghetti to be delivered in January 2028. Pastina credited deferred sales revenue at the time the cash was received. So we're told that we received $2,000 in advance from a customer, but we're not going to actually earn that money until January 28th when we actually deliver this spaghetti. So, but we have to account for the cash that we received. So at the time we received it, we would have debited cash for $2,000 and credited deferred sales revenue, which is a liability. Okay. And at December year end, there's no adjusting entry needed, okay, because we don't recognize that revenue until January 2028. And at that time, we will reverse our deferred sales revenue amount and recognize the revenue. Okay, item number 8. On December 1, 2027, $2,000 rent was paid to the owner of the building. The prepayment represented rent for December 2027 and January 2028 at $1,000 per month. The entire amount was debited to prepaid rent at the time of the payment. So at the time of the payment, we paid rent in advance. So we debited prepaid rent for $2,000 and credited cash for $2,000. Now we're at December 31 where we've used up, right? We've occupied the space for 1 month. So we've essentially incurred that rent expense for 1 month. So we're going to debit rent expense for $1,000 and credit prepaid rent for $1,000, which means that our prepaid rent should have an ending balance of $1,000, which is what it should have to cover the month of January 2028. Our final entry says, assume no common stock was issued during the year and that $4,000 of cash dividends were paid to shareholders during the year. Okay, so when we have, well, first of all, this is kind of telling us 2 different transactions or a lack of a transaction. Assume no common stock was issued during the year. Okay, so there's no entry for that. And the $4,000 of cash dividends that were paid to the shareholders, that will actually be part of our closing entry, and we'll close that out to retained earnings, and we'll see that in future videos when we do our closing trial balance. So this is going to be the end of video 1, and we're going to continue with our adjusted trial balance on video 2.